The 5 sustainability mantras are non-fossil fuel energy capacity to reach 500 gigawatts, 50% of India's energy requirements to come from renewable energy, reduce total projected carbon emissions by 1 billion tons, reduce the carbon intensity of our economy by 45%, and achieve net zero. The first 4 of these mantras to be achieved by 2030 and net zero to be achieved by 2070. India's sustainability agenda is not just an environmental commitment. It has important economic and growth implications as well. As India moves along the path of sustainability, India can become a hub for new technology and its deployment. For example, in the field of green hydrogen, drawing upon its learnings from the renewable sector, India can champion a significant lowering of costs compared to what is available in international markets. As new technologies and regulations move towards promoting sustainable lifestyles, investing in sustainability is required to be at the forefront of new industries. This will create a leadership position for India in sectors of tomorrow and create new, possibly higher income jobs for such industries. As is said, investing in net zero is a net positive for the economy as well. India needs to invest trillions of dollars to meet its net zero by 70 objective. Estimates run from hundreds of billions of dollars over the next decade to over 10 trillion over the next half century. This is a significant proportion of India's current and projected GDP. To get a sense of broad numbers, just going from the current 160 gigawatts of installed renewable capacity to 500 gigawatts, India will require over $200 billion of investments. This does not include expensive technology like offshore wind, where the capex cost per gigawatt could be much higher than for solar and wind. Similarly, our estimates indicate that to create an annual supply of 7 to 8 million tons of green hydrogen will require a cumulative capex of 160 billion, with more than half of it actually being invested in generating renewable energy. The electric vehicle ecosystem will require another 180 to 200 billion dollars by 2030. 3 types of capital will be required from resources, risk capital, and debt. The government has shown the way via the regulatory innovation in the case of renewable energy. The creation of Solar Energy Corporation of India, combined with tools such as priority dispatch, was crucial to give a fillip to private investment in the renewable sector. And these steps helped create massive scale, which brought down overall capital expenditure costs. The result is now that renewable energy generation is in many cases cheaper than coal-fired power. In fact, in the month of July, India produced 14% of its energy using renewable sources. Equity capital for renewable energy investments is coming mostly from foreign investors. Even for homegrown companies, the investors are now largely foreign. Creating institutions that are aligned to link international and domestic finance to climate-related projects can help create local capacity and enable faster deployment. The case study of the Green Growth Equity Fund in India is interesting in this regard. Seeded by NIIF with a commitment of $170 million, along with a matching commitment from the FCDO, the Foreign Commonwealth and Development Office of the UK, GGF has gone to become one of the largest single country climate focused funds in emerging markets with a corpus of $740 million US. The fund has attracted marquee investors from across the world, including the Green Climate Fund. With about just $85 million of Government of India commitment, this platform has crowded in 9 times of that amount from others. In fact, taking the project entities that GGF will further invest into and the debt in those entities, the ultimate leverage of the government contribution could be as high as 25 to 30 times. As these green industries mature, companies will require large amounts of debt financing. We have seen this in the solar sector as well, and this will soon be required in other renewable sectors and new sectors such as battery storage, electric transport, and so on. Currently, Indian banks and capital markets, mutual funds are supporting such debt. Domestic institutional capital from insurance and pension funds will be needed as well. Institutions such as NABFID will certainly play a crucial role in providing long-term, low-cost debt capital. Funding across the range of equity, debt, mezzanine, impact, grants will be required and will vary spanning the risk-return spectrum of the industry. Each type of capital will also segment itself into different categories, from those willing to take small risks on many investments to those willing to invest larger amounts on mature technologies and projects and industries. Sovereigns and sovereign-backed institutions, development finance institutions, venture capital funds, sustainable impact funds are likely to take the lead in funding newer technologies, riskier projects, or projects with no immediate monetization possibilities. Long-term financing institutions such as pension funds, insurance companies will play at different ends of the control spectrum. An attractive financial innovation to enable the flow of capital and financing into the sustainability sector will be green InvITs. Green assets which have operating cash flows can be transferred into a green InvIT. With solar sector assets maturing, this could be an important avenue for unlocking capital. Here too, investments by local pension and insurance funds will be important. Infrastructure financing is fundamentally a local currency business, and domestic savings are needed to play an important role in the sector, while benefiting from its long-term stable cash flows as well. A significant amount of foreign capital is keen to invest in India's green transition as well. The IFSCA, the International Financial Services Centers Authority, has championed the creation of policies in attracting foreign capital through GIFT City. Sustainable financing, including products such as green bonds, could be raised and listed at GIFT. Pooling hard currency investments in GIFT City to invest into mainland India will support the large investments needed for the sustainability projects. Sustainability will be an important industry of tomorrow. India has come a long way and has the potential to play a leadership role in many areas of sustainability. We do look forward to a much brighter and greener future, and for India to play a key role in that future.
Thank you very much, sir, for sharing your insights. We regret that Mr. Parameswaran Iyer, CEO NITI Aayog, has unfortunately not been able to join us due to some exigencies. We bring this session to a close here and would request our viewers to join us for the next session with Mr. Tuhin Kanta Pandey, Secretary Deepam, Ministry of Finance, which would begin at 3:15 p.m. today. Thank you.